Well, insurance is one of the few industries where technology and humanity collide quite directly. On the one hand, artificial intelligence and automation are really transforming things like underwriting and pricing and claims processing at an extraordinary speed. On the other, the real test of insurance still comes in those really human moments after a fire or an accident or a flood or the loss of a loved one. So the question for insurers today isn't just how fast they can digitize, it's how they balance technological efficiency with the empathy and trust that customers expect when things go wrong. Hello and welcome to the Monocle Banking Podcast, curated by Monocle Solutions. I'm Michael Avery. Across Africa, this tension between digital innovation and human empathy is playing out in particularly fascinating ways. Markets like Kenya and Ghana are demonstrating how mobile-first financial ecosystems can accelerate digital insurance adoption, while more mature markets like South Africa are grappling with questions around ethical AI and consumer trust and data privacy as this tech becomes more deeply embedded in financial services. So today, we're exploring how insurers manage those two parallel journeys, the functional journey where automation can improve efficiency and scale, and the emotional journey where human judgment and empathy with a capital E certainly remain essential. And joining me for that conversation is Pravin Kalpage, CEO of Hollard International, who brings a very unique vantage point from operating across multiple African markets and just seeing firsthand how technology and regulation and customer expectations are reshaping the sector. PK, welcome to the Monocle Banking Podcast. You're approaching 7 years as CEO, 15 with the group, and started out in management consulting, I see, with Bain. What first drew you into the industry?
Good morning, Michael, and thank you so much for having me on your show. So I think when I first got into the industry, I wasn't really looking for a specific industry. I was looking for a particular kind of company. And I think I found a company that was purpose-led, a set of shareholders who really drove that purpose quite hard. And that is what attracted me to Hollard 15 years ago.
And clearly you've seen the industry evolve over the period where we've probably seen the most rapid technological disruption. So from your vantage point, what have been those big evolutionary leaps that the insurance industry has witnessed over your time with Hollard?
So I think, as you said in the introduction, I have the advantage of playing across different markets on the continent and actually comparing that to the journey that we have traveled in South Africa. I think one obviously is the fact that there are more and more people who are aware about insurance and what insurance can provide. And I think that has definitely advanced quite significantly. Secondly, from a technological point of view, how we distribute insurance. I think from the tried and tested agent-led, call center-led models, I think now we're moving to very much tech-enabled, MNO-enabled distribution models. So I think that is the second part of it. The third part of it is in terms of really understanding customers' needs at a much more granular level and designing products that are suitable for them. We talk about a future where there is a hyper me, a real focus on my needs as opposed to sort of broader needs and looking for extreme personalization. I think we're still evolving on that journey, but I think there's much more appreciation of really understanding needs and designing products for that demand. And then I think on the other side of it, once someone buys a policy, in terms of how they interact with you, I think that has fundamentally started to transform as well. Previously, you'd buy an insurance policy and then you won't hear from your insurer until the point you need to claim. I think that interaction has changed fundamentally because you have the ability to go and check whether it's through an app or whether it's online, check on what's happening with your policy, whether your policy is up to date, whether you've got a cashback that's coming back to you, whether a premium payment is due, when you intimate a claim, when you're going to get your payment, where you are in that process. So I think technology has really fundamentally changed that whole journey and it continues to evolve.
There's so much to unpack in that. And maybe let's just start with that last point that you raised, because when I look at the fintech ecosystem broadly, I always thought that banks were probably at more of an advantage to digitize, and not just digitize legacy processes, but actually redesign the banking model itself. Because of the nature of banking, if you go onto an app, you're much more likely to be interacting with your bank daily on an app to check balances, to transfer funds, to invest, to do whatever you do. And I always thought insurance maybe was on the back foot, to your earlier point, because, you buy a policy and hopefully you won't have to claim, but then the next follow-up is generally when you have to claim. But you've just described that model itself is actually changing. So you are acquiring more opportunities to interact with your clients on a more regular basis. So can you just unpack how that journey is playing itself out inside Hollard?
Yes, I think it's probably twofold, Michael. So I think there are insurer-only plays, and then there are what we call ecosystem plays, right? So in an insurer-only play, there are examples of if you've got a loyalty program, you use that as a way to interact with the customer on a much more frequent basis. So you might have different benefits, different levels of benefits on that loyalty program, depending on how frequently you come onto the app and interact or pay your premium or a whole host of things, right? So that is one model where I think from the previous model of having very few interactions, now there is sort of a monthly interaction going on through loyalty. And then the second one, which I think is really going to define the future of insurance in the future, is what we call this ecosystem play. I think as Hollard, we've always recognized that we are not going to necessarily be the best entity to do the whole value chain in terms of insurance. There is advantage of partnering with like-minded people as part of a larger ecosystem. There could be people who are better at acquiring these customers because they are already the customer, whether that's a bank, whether that's an MNO, whether that's a retailer. It could be a whole host of players, but they could play the distribution chain part of the process. And then there could be others who play different other parts in the value chain. But now as part of that, if you're part of that ecosystem, the customer is probably already interacting with that MNO on a daily basis. And then this insurance conversation becomes much easier to have rather than the previous one.
That makes a lot of sense. It would probably also lower your acquisition costs quite fundamentally, but I guess also then raises the question of who owns the customer. In an embedded model, does the insurer risk becoming maybe just a balance sheet provider while the platform captures the customer relationship and the data?
And I think that is a big question going forward. I think traditionally our view has been that let's design an ecosystem that takes frictional cost out of it for the customer. And let's do this together. So let's set up, whether it's a joint venture or a virtual joint venture, virtual insurance company, to deliver to the customer. I think this question about customer ownership is becoming more and more important. We haven't had a situation where we've had serious disagreements about how we take some of these joint ventures or partnerships forward, but I think that's something that we will need to grapple with more and more as we move forward.
Mm-hmm. As you move forward with that, and just through the financial lens of the business, how do you think about some of the trade-offs here? Would you be willing to, say, accept maybe a lower margin per policy in exchange for higher volume and better persistency?
Absolutely, Michael. And that has been our model since when we started in 1980. I think ours is primarily a partnership model. And I think what we've said is that in order to be part of that ecosystem, we're willing to take a smaller margin and potentially share profit in markets where that is obviously allowed in order to make sure that we touch more customers. And I think some of the partnerships that we've developed over the years is testament to that.
When it comes to data, I can clearly see an advantage here in an ecosystem being able to acquire much more granular customer level data, which surely must be able to help you with underwriting and pricing. To what extent are you seeing that emerge as a big advantage through the model?
Michael, if I'm honest, I think we are at very early stages of really taking advantage of that. I think we've got lots of ecosystem partnerships in the different markets in which we operate, where in theory you have access to some very rich data. Where you have a partnership with the MNO, I mean, think about the data that you have in terms of where that customer is, what kind of transactions they're doing, because a lot of people do transactions on their phone now. I think really understanding at what stage of that life that customer is, what their needs are, at a point in time is all available. Are we really taking advantage of that at this point? I would say no, but I think we are charting a journey to really get much better at that. And I think that is the success or failure of that, I think, is going to define how the insurance landscape evolves.
Absolutely. I was having a very interesting conversation with Shamil Jusub, the CEO of Vodacom, and just in building out some of their kind of micro lending, micro credit business. And it's remarkable how using things like AI and predictive analytics to help them underwrite and to extend micro loans, just by the time of day that someone requested a loan would be a key indicator on their propensity to repay. And, with 90-something% confidence, it was highly, highly accurate. Bit of a black box, though, because I asked him, well, how does that work? He said, well, we're still trying to figure that out ourselves. And, it brings me kind of to AI, I guess, because it's a buzzword, let's face it. Everyone's talking about it. But we are seeing genuine use cases and a lot of value. Where are you thinking about AI? Is it making a material difference today in anything in the business, from maybe underwriting or claims processing, not as a pilot, but in real live operations?
It is in pockets. And I think that is also a learning that we have is you need to have test use cases in different parts of the value chain. But I think there's also value in picking one part of your value chain, if it's claims, and seeing how you can really maximize benefit in that. So the business that we have in Kenya has done a lot of work in terms of using AI in claims processing. And in that particular market, especially in health, there is unfortunately a high incidence of fraud, potentially in terms of claims that are submitted, but also in some of the network providers who provide the service to the customers. What AI has been able to do is to go through all of those statements, obviously in a matter of seconds, and really identify where there are some significant discrepancies in terms of the statements and cut out a significant portion of fraud. So the claims process, I think, is going to be definitely one big area of opportunity in terms of AI. I think that's the one thing. Secondly, if I can just add one more, I think there is a huge opportunity. We call this AI for everyone. I think there's AI for specialist use cases, and then there's AI for everyone. I think there is a huge opportunity, and this is not industry specific, but for everyone in the organization to be significantly more productive just by understanding what AI can do for their in terms of day-to-day tasks and to start using it. So I think we're trying to push both of those sort of verticals forward in terms of AI.
And within that, would you say you're seeing measurable improvement in loss ratios from, let's talk about that specific use case in claims and fraud and loss? Are you seeing an improvement there from AI-driven fraud detection and that kind of claims triage?
We are. It's still early days. So, whether this is how sustainable this is going forward, I think is something that is open and the jury is out on that. But we're definitely saying at least a 2% improvement in loss ratios in that specific case, which is significant on the volumes of health business that we're writing in that market.
I wonder, if you just think about this, whether AI ultimately shifts insurance from a risk pooling model towards maybe a risk segmentation model. And what does that do to long-term stability of the industry? Because I suppose one must guard against this kind of adverse selection in reverse, where your best risks are underpriced by competitors using more aggressive models. Where do you see this going, PK?
I think that's a big question, Michael, and I'm not sure that I have a ready answer for that. But I think definitely the risk that you're highlighting is a possibility. I think we really need to think carefully, obviously use AI and sharpen your pencil, absolutely. But where it takes the industry in terms of risk pooling, risk segmentation is absolutely something that we need to think about. If it results in a drive to the bottom in terms of good risks, then I think we're going to destroy value in this industry. On the flip side, I think what it does allow customers is to really do some comparisons in much more real time and really understand where they are best served in terms of the needs that they have. There's a significant value add on the customer side in terms of AI as well.
When it comes to how you approach spending into this technology, and there's a lot of talk around AI capex, certainly amongst the hyperscalers. It's everything we talk about in the markets at the moment. They're building out huge data centers and all of that. We know the banks, it's one of their fastest growing line items, is the amount of capital that is being spent to harness the power of this technology. How are you thinking about that? And coming back to your very first statement about finding a company that has maybe shareholders that have a bit more patient capital, let's say, does that give you maybe something of a strategic advantage on spending into this trend before you start seeing real meaningful returns?
Absolutely, it does, Michael. And I think the first question, traditionally when you're trying to spend a large amount of money, the question you ask is, can you afford it, right? I think here, in this case, is can you afford not to spend it, I think, is the real question. Because I think whether we like it or not, this trend is going to evolve and is going to develop the insurance industry and other industries in ways that we haven't expected in the past. So I think we really don't have an option to not invest. I think how we go about it and how we pick certain verticals to really drive value so that you are going to get value out of it in the medium term is something that you need to think about. But I think going back to your point about patient shareholders, I think we have a significant advantage in being a privately held organization and with two sets of shareholders in Yellowwoods and Tokyo Marine who really believe in investing in technology. So I think we are at a significant advantage. The conversations that we have about investment in technology are relatively easy. Obviously, it's robust because these are big investments, but relatively easy because they see the value. And I think what both our shareholders have also been doing is, even at a shareholder level, they're making investments on their own to then broadly support the businesses as we move forward. So it really helps.
That's very interesting. That's great insights, PK. Thank you. If you just look across your African markets, how does that conversation go when you decide what to spend on? Are you prioritizing maybe top line growth, expanding your penetration, or margin discipline, just given the protection gap, but also the volatility that we might see in Africa? And then aligned to that, which markets currently offer the best risk-adjusted returns, not just headline growth?
So I think we have the advantage, as I said earlier, on playing in different parts of the continent. So we've got quite a few businesses in Southern Africa, which are our more mature markets. We've made a investment in East Africa in a business called APA, which covers Tanzania, Kenya, and Uganda. And then we've got a business in Ghana in West Africa, and we have opportunity to expand there as well. I think what we see is that from a growth point of view, East Africa and West Africa are far outstripping the growth that we see in Southern Africa. And that comes from two angles. The first is that those economies themselves are growing at 5, 6, 7, 8%. So that drives insurance growth as well. But secondly, they are significantly underpenetrated compared to a place like South Africa. So there is a growth that comes through that as well. So I think from a growth point of view, we're seeing significant opportunity there. In some of those markets, because they are less mature than a place like South Africa, and you may have a less of a competitive dynamic. So a place like Ghana, for example, you have the ability to drive higher underwriting margins than you would in a place like South Africa. Another market like that in Southern Africa is Mozambique, which is, compared to even places like Namibia and Botswana, is probably less mature and as a result, less competitive. There is the ability to drive significantly higher underwriting margins. But I think what we are seeing is that as these markets mature and as traditional insurance lines like corporate and commercial and personal lines get more and more saturated, the opportunity is really going to be in terms of how you serve the underserved, currently underserved. And I think this is where technology, AI, and really being able to bring that cost of distribution, cost to serve down is going to differentiate the people who will succeed and the people who may not be as successful.
I think that's a really interesting answer because often, when we look at the African opportunity, that does seem to be the big challenge in more informal markets and getting distribution right and how we build products to serve the underprotected or unbanked or underserved. What do you think the keys are to meet that market where they are? I was at an employee benefits conference in Diani Beach in Kenya late last year. And it's one of the big challenges when you're talking about a workforce that is highly informalized. Income is largely irregular, but people still want to save. They still have a propensity to try and look after their own financial well-being. But you can't take a traditional kind of monthly product and say, let's just copy and paste that and replicate that in that market.
Absolutely. And I think Kenya is a great example because it has obviously leapfrogged quite a few other markets from a banking point of view. I think through sort of mobile-based borrowing and lending and transacting, that market has leapfrogged. But I think I've spent quite a bit of time in some of the informal settlements in Kenya, talking to people about their needs for insurance. And I think the need is absolutely there. It's really about how you use technology, how you use mobile network operators to be able to get to these customers and acquire them much more cost effectively, and then to be able to serve them on an ongoing basis cost effectively as well. I mean, the example I would give is there is a provider, a banking provider in Kenya, who provides loans on a daily basis, right? So in the morning when someone wakes up and before they go to work, before they go and buy the goods that they require to sell that day, they take a loan. At the end of the day, once they've finished all of their sales, then they pay back the loan, right? And the banks, as you mentioned earlier, then use that information and the consistency of taking that loan and then paying it back to then gradually increase the sum that they're willing to lend this individual. So if banking can do that, then I think it's not inconceivable that insurers can't come up with something that is creative around premium payment and so on and so forth in a market like that.
A huge opportunity. So given all of this is really exciting, I think, one of the key pieces of the puzzle in getting this right must be to ensure that consumers, customers, people on the street believe and trust in this. And I think one of the big issues globally isn't whether AI can work, but whether customers actually trust how it works. And it almost comes back to my black box example that I mentioned earlier. How do you build trust when a customer suspects maybe an algorithm is deciding whether they're insurable and what they should pay or how the claim is being assessed? Do customers need much more explainability in plain language, even if the model itself is technically very reliable, very sophisticated and trustworthy?
So consumer education, as you allude to it, Michael, is going to be absolutely important because I think there are lots of situations where customers have lost trust in insurance for a variety of reasons, and then they've gone to other ways of managing this risk. So I think ensuring that there is customer education and awareness building is absolutely important. But then I think the important thing is really demonstrating the ability to pay claims. And if in a situation, if there is a fire in an informal settlement and quite a few people have lost their homes, if you now take 3 months to pay that claim, then you are destroying trust, right? Or the flip side, if you are on site the next day and you're now helping these customers get back on their feet, you will immediately build trust. So I think it goes back to what you said right at the start, that I think there is a functional journey which we must absolutely automate using digital and using AI. And that talks about the underwriting, the pricing, and deciding whether you pay claims or not. But then I think there is an emotional journey around the claims event itself and how you handle that and how you interact at that point in time, which is absolutely critical to be done by a human. And I think you can't now outsource that to AI, definitely at this stage of development, and expect to retain trust in this process.
Yeah, and that comes back to what I said in my introduction about this really being a dual journey process. For you as a leader, PK, how difficult is it to lead this transition inside an insurer? Because, technology change is one thing, but I think culture change is quite a different thing altogether. And often organizations, what I've seen in big organizations, often when you try and lead these projects, there is organizational antibodies that are released that try and go and attack and inoculate against any kind of change. Are the biggest constraints technical as you see them, or human in leading an organization of the size and scale of Hollard International through a change like this?
I think you are absolutely right. I think the challenge is going to be more human than technical. Obviously, there's a technical challenge that exists, but I think the culture change that is required to be successful on this journey is massive in my mind, right? And I don't think it is something that you can change in a week or a month or even maybe in 6 months. I think all of us have grown up in this industry in a particular way, which is much more manual than what it's going to be in the future. And if we are going to embrace this dual approach of having a very functional journey, which is highly efficient, and an emotional journey, which is still remains very human, I think we really have to bring all our people along that journey. And I think that's why it's so critical that this is not something that is designed in a boardroom with an executive team, but as you design this journey, you involve leaders, the first level of leaders, next level of leaders throughout the organization so that you can bring everyone along on this journey. But it's definitely not a straightforward process, and it's not a linear process. I think it's definitely going to be a iterative process in order to enact that culture change, Michael.
Well, Pravin, I think a powerful place to leave it. Thank you very much, because obviously the real test of modern insurance is not whether it becomes more digital, but whether it still remains recognizably human while leaning into these powerful digital tools and enablers to lower the protection gap across Africa and grow the business in a way that creates this kind of shared value that insurance can do. When we talk about, financial inclusion, I think insurance has a key role to play in that. So thanks so much for your time and insights in the Monocle Banking Podcast.
Thank you, Michael. Thanks so much for your time.
Well, if there's one thing that stands out from this conversation, it's that insurance is probably undergoing one of the most profound transformations in financial services, but perhaps without the same noise, or at least certainly the hype that we've seen in banking or payments. Technology is making insurers much faster, it's making them much leaner and a lot more precise. And that's all powered by increased access to this data that enables a much more personalized and dynamic and potentially more preventative model of risks. And ecosystems are certainly redefining how insurance is distributed, embedding into the everyday moments where risk actually lives. But at the same time, the fundamentals haven't changed. Insurance is still a promise that only really matters when something has gone wrong. And I think that's where the real test is always going to lie. Well, you've been listening to the Monocle Banking Podcast, curated by Monocle Solutions. I'm Michael Avery. Until next time.